Well, let's find out now. We're going to talk with Adam Button, the chief currency analyst at ForexLive, joining us to weigh in. Good to see you, Adam.
Hi, Greg.
All right, so what got to the Fed? What got to Jay Powell? Only 6 or 7 months ago, you and I were talking about when they would raise again.
It's amazing. It's an amazing turnaround. In a sense, it's sad. You have a stock market that's at all-time highs and the Fed running and panicking in being bullied into cutting rates. They dropped patient. And I think if you look word for word and you look at it, you say, well, they didn't say that much. But the important thing to remember is that markets were pricing in an 85% chance of a hike before Powell came out. And he knew that. He didn't push back against it at all. In fact, he even entertained the idea of a 50 basis point cut. And that's why we are where we are today, with stock markets rallying, bond markets rallying, everything rallying, because we're back into that era of cheap money.
What do you think forced his hand? I mean, the market obviously was pricing in. When you take a look at the movement in bond yields, very dramatic over the past 6 or 7 months. Donald Trump always hammering him on Twitter, although Jay Powell says, listen, we make up our own mind about things. What do you think was really driving him?
Well, it's hard to take all that seriously now. A lot of it was the market bullying, but the Fed should really step back from that. Remember, they talked about data dependence for 3 or 4 years, and the data has been solid, certainly not anything pointing to a cut. Now, the bond market definitely spooked them, but I think what really pushed them over the edge was inflation. And we've been talking about this for years as well. It's low. Globalization pushes down inflation, and it just hasn't materialized in the way they thought it would. Now, that's a good reason to be patient. It's not such a great reason to cut. And, obviously they're worried about trade risks here, and we're going to have to see how those develop, but they've put themselves into a box. They have to cut no matter what now come July.
The equity market reaction this week to me has been interesting because I feel like people trading stocks want it both ways. Stocks rallied on the news that Xi Jinping, Donald Trump, will meet on the sidelines of the G20 in Japan. But to me, if you're a central banker and you're worried about the global economy, the big thing you're worried about is global trade tensions. So if the tensions go away, in my mind, I can't square how you have an accommodative central bank if the trade tensions aren't a problem anymore.
And that's what's so difficult about this decision, because there's no backing away from this now. And it really have to go back to inflation. They dropped that talk about transitory pressures keeping inflation low, and they just accept now that it's low, and they're worried about it because there is always going to be a good chance that come July there has been an improvement, or even if we're just where we are right now. I mean, this isn't going to be a declared trade war where it's like a real war and bombs are falling. It will just get progressively worse, and there'll be ebb and flow within it. So for either Powell knows something we don't, which should scare the equity market, or he's just put on a huge Powell put. And I think what's even more important in the equity market reaction is we're saying, listen, this isn't the state of play for July or through year end. This is the state of play now as long as Powell's there. Powell is a dove, and he's going to be bullied by the market for the next 3 years.
So what happens to the U.S. buck then? Because Donald Trump definitely likes to see it lower. It has moved lower in the past 2 days. But then in tumultuous times, it's also seen as a haven currency. So it seems like we have conflicting things there. We have a dovish central bank. But if things get very bad at the geopolitical level, investors often turn to the U.S. buck.
Right. That's the difficult thing in currency markets, because there's a sequence to these things. If you look at what Powell pointed out, it was that global growth is slowing. It's that trade is a problem. Now, those aren't just U.S.-centric problems. So maybe it hits the U.S. first, but it eventually spills over from there. And that's the worry, is that you rush out of the U.S. dollar, and then say the Bank of Canada starts to cut, and then you have to turn around and reverse that. And that's exactly what happened in the global financial crisis, where it was the U.S. dollar that got beaten up first, and then it was this massive safe haven trade, and it turned completely around. So that's probably what will unfold again this time. The flip side is that maybe the Fed is just ahead of it, and they can engineer a soft landing. You get some U.S. dollar weakness, and that sort of lifts global growth back up, and the Canadian dollar can kind of float around these levels, and after it runs a little bit higher.
Got less than a minute left, Adam, but I got to ask you about the Canadian dollar. Obviously, the Fed was a big driver yesterday. Oil today. We jumped more than a full cent against the greenback over 2 sessions.
Yeah, I mean, the Canadian dollar the Bank of Canada really is finding itself in a lonely spot here because they can't cut right now. The data has been too good domestically. And so they're stuck sort of waiting this out, and they'll be watching the Canadian dollar go, especially if oil can continue to track higher. If there's any good news out of trade, you can easily see the Canadian dollar 3, 4, 5 cents from here over the next 6 months.
Adam, always a pleasure. Thanks for joining us.
Thanks, Greg.
It's Adam Button. He's the chief currency analyst at ForexLive.